Join us now, Mike Wilson, Morgan Stanley CIO and Chief U.S. Equity Strategist. The reason I said you're so smart about physics is I'm reading how you're basing some of your calls, and you are like tackling the most difficult things to forecast. You're not just like looking at momentum and stocks maybe continuing to go up. You're trying to decide whether there's a recession risk. You're trying to decide whether, at this point, Bullard just said it, you think the recession risk is behind us and we're reaccelerating now. The economy is reaccelerating already.
Yeah, I mean, I think forecasting stock markets is as hard as coming up with gigawatts or gigawatts. Okay, trust me.
Well, you're not even doing stock markets. You're doing the economy and the Fed.
Yeah, I mean,
they can't do it.
Well, I mean, look, it's difficult, right? We're trying to live 6 months in the future, and I think the market does live 6 months in the future, as we've said many, many times. And our thesis for the last 2 or 3 years has been very consistent. We think we've been in a rolling recession for 3 years, and we've documented this in quite a bit of detail. The last couple of weeks, we've actually gotten more information around the job revisions, not just the big one that we get the 911,000, but also the 2-month payrolls. And we've done some pretty interesting analysis there that shows very clearly, that the trough of the labor cycle was in March, April, okay? Whether you're looking at job cuts or you're looking at the payroll revisions. And that bottomed, okay, with the government recession in Doge, which is what we were waiting for. So that was all of our thesis for this year. So we feel pretty good. We have the right narrative now. The market, by the way, is our confirmation. The market figured this out at the exact same time. So that, like the old adage, trust but verify. We trust our analysis, but the market kind of verifies it.
I was going to ask you, if we went through a recession, why are we at new highs? But you said it didn't happen until the recession was already over.
That's right. Well, typically, remember, Joe, when the market always bottoms during a recession. It doesn't bottom when it's over, when it's obvious to everybody, okay? Now, the Fed's working on lagging data, like always. By the way, that's not new either. This is not an unusual feature. We saw the same thing in 2008. We saw the same thing in 2001. Okay, we documented this. So this is very apropos for how it usually works. The one thing that's missing this time, or it's different than 2001 and 2008, is the Fed is actually behind the curve more than they have been in other cycles because of that lagging labor data, which we think will catch up in probably November when all those Doge employees who were let go have to file for unemployment insurance.
All right, so we're going to continue, even though we've already bottomed, we're going to continue to get some straggling bad numbers.
Absolutely, that's the way it always works.
They're going to straggle in.
Interesting statistic, okay, which is the market, okay, typically bottoms a year before the unemployment rate peaks. That's typical.
Why should the Fed be cutting now then? They should be raising.
Well, because there are other reasons they're cutting. Okay, first of all, we do need to cut because in order to get a full recovery, right, the rolling recovery now, we need rates lower. One of the reasons why we've had a tepid, kind of economy in the private sector is because rates are too high for most businesses, particularly small businesses and consumers. So they do need to cut rates. The question is, how much are they going to cut? And that's why we haven't seen the full rotation yet to the early cycle, small cap, low quality parts of the market. Okay, so I believe that last week was sort of a sell the news event because the Fed is sort of dragging its feet. They cut 25, and the market really wants or expects, or it's priced for, more importantly, for something more aggressive. So we have this window now for probably the next 6 weeks or so where we think the market is at risk of this tension between the Fed being kind of behind its own curve and the bond market, and the equity markets really wanting or needing now a more aggressive Fed path.
But the background, your whole overriding theme is that we're early cycle. Isn't early cycle? If you're patient for the next 6 weeks, shouldn't you be buying stocks here then if we're early cycle? I mean, are you telling people right now we're early cycle and it could be the beginning of a multi-year period of rising stock prices?
It's exactly our call. We said very clearly that, April was the end of a bear market. The Liberation Week was the final piece of bad news you typically get at the end of a major bear market. And by the way, just to be clear, the average stock was down 35% between April of 24 and April of 25. That's a proper bear market. So the new bull market began in April, and now it's evolving, and the stock market's ahead of kind of the data, as it typically is. We've seen, by the way, just because small caps and low quality early cycle stocks haven't outperformed, they have gone up in absolute terms significantly. So the market is telling us that that thesis is correct for now, and the risk of that is that the Fed stays behind the curve longer than the market expects, and we have a little digestion here, which could be a meaningful correction in the next 6 weeks. We'll see how it goes. But either way, that doesn't change our thesis that the early cycle rolling recovery has begun.
I can see going against a consensus, but just about everything you just said is 180 degrees from where most people think we are.
Not the first time.
Not the first time. Well, time will tell.
That's right.